Good morning and welcome to Zicklin Talks Business. I'm Bruce Weber, the Willem Quaker Dean of the Zicklin School of Business, and I'm delighted to have you with us for today's timely and thought-provoking conversation. Few household instruments shape American households as profoundly as the 30-year fixed mortgage. It was a Depression-era innovation created by the Federal Housing Administration in the 1930s to rescue foreclosed homeowners and move the country away from risky 5-year balloon loans. Over time, the fixed-rate mortgage became a defining feature of U.S. housing finance and a cornerstone of the country's economic stability. Today, Americans carry more than $12 trillion in mortgage debt, and the history of interest rates reminds us how consequential the design of mortgages can be. In 1981, 30-year fixed mortgage rates peaked at 18.5%. Even after rates fell from their 1980s extremes, recent years have not been steady. Borrowing costs dropped below 3% in 2020, historic lows that fueled a refinancing boom, only to climb above 7% by late 2022, the highest level in 2 decades. When rates rise like this, homeowners with low fixed rate mortgages often feel stuck. Selling a home means giving up the value embedded in their existing loan, and that lock-in effect ripples through the broader economy. These swings remind us that mortgage design matters and that rate movements shape where Americans live, when they move, and how they build long-term financial stability. Today's webinar asks whether a different model could ease this lock-in effect. Denmark, Scandinavian country, offers a compelling alternative. Danish fixed-rate mortgages look familiar to American borrowers, but with one crucial difference. When interest rates rise, Danish homeowners can purchase their mortgages at market value. Instead of forfeiting the benefit of their low-rate debt, they capture it, preserving mobility and reducing friction. Could such a system work in the United States? What regulatory, institutional, and market changes would be required? And could Danish-style buyback rights enhance U.S. household flexibility without undermining housing affordability? To explore these questions, Baruch graduate and our namesake, Larry Zicklin, class of 1957, will lead a conversation with Professor Fabrice Tour of our Burt Wasserman Department of Economics and Finance. Fabrice holds a PhD in economics from the University of Chicago, and his research examines how financial institutions, regulations, and contract design shape risk, pricing, and household finances. His insights will help us understand what a Danish-inspired mortgage system could mean for U.S. households and our economy. We'll reserve time at the end for audience questions, which you can submit through Zoom's chat feature to my colleague, Associate Dean Gwen Webb. Larry, the floor is yours.
Thank you very much, Bruce. I appreciate it. Fabrice, the genesis of this webinar is the paper you and your co-authors wrote on the U.S. and Danish mortgage market, which we will discuss. But I'm curious first as to what brought you to write that paper along with your colleagues. What was the impetus for that?
Good morning, Larry. And let me try to explain where this research idea came from. It came from, number one, my time spent in Denmark as an assistant professor a few years ago. Number two, it came from my overall research agenda, which has been very much focused on the mortgage market in the US. Over the years, I've tried to better understand the degree to which interest rates and changes in interest rates pass through to the real economy via the mortgage market. And through that research, I've encountered, alongside co-authors and colleagues in the profession, we've encountered this striking fact, which is that in the United States, when we look at household mobility, it looks like household mobility depends partly on the degree to which mortgage borrowers have an interest rate on their mortgage below or above current market interest rates. And the fact that I've documented in a paper and that colleagues in the profession have documented in separate papers is the idea that when current mortgage market rates are significantly above interest rates that are currently paid by households on their mortgage, mobility declines significantly for mortgage borrowers.
I must tell you, it was that paper that initiated this webinar. But I just want to make sure we're going to be talking about 30-year mortgages.
That is correct. So you're absolutely right. Let me clarify for the audience. The biggest focus of the discussion today will be on the 30-year fixed rate mortgage contract, which is the benchmark contract in the United States. It's a contract that is freely prepayable at par. So that's an important thing to remember. So this research that I conducted focusing on U.S. fixed rate prepayable mortgage contract had applications and had connections with a Danish mortgage system, which happens to be very similar in terms of institutional infrastructure to the US.
So let's begin by just describing how the mortgage market works in the US. Can you describe what happens to a typical 30-year fixed rate mortgage when a couple goes out and buys a $400,000 house and takes a mortgage out of $300,000? What happens to that mortgage?
Totally. So I think it's important to actually clarify. In the example, Larry, that you're suggesting, the household buys a $400,000 house. At the time of the purchase, the household finance portions of the house purchase through the issuance of a mortgage.
$300,000.
Exactly. So $300,000 is going to be the mortgage face value. And let's assume that this mortgage is taken at a time mortgage interest rates are 6%. So the the borrower contractually commits to make 360 equally sized payments, one payment per month, such that the implied interest rate on these monthly payments is 6%. So this is the 30-year fixed rate mortgage contract, which is an annuity. And one of the key features of that contract is that if later on mortgage interest rates come down, this household, who is basically committed to pay an interest rate of 6%, is allowed at no cost to refinance that mortgage into a lower interest rate mortgage if and when the time comes and if and when mortgage interest rates come down.
But what's the role, before we get there, what is the role of Ginnie Mae, Fannie Mae, Freddie Mac, the mortgage market, the local bank in this transaction?
Yeah, great question. So I'm going to describe the current mortgage environment, and I don't want to give a history of the mortgage market, but in today's environment, the mortgage market is bifurcated into two sections. One section that we call conforming mortgages. These are mortgages that are below a certain face value, below what we call the conforming mortgage limit. These mortgages in the United States, they are guaranteed directly or indirectly by the federal government through mortgage agencies. So, the audience will have, of course, heard about Fannie Mae, Freddie Mac, and Ginnie Mae. So Ginnie Mae, it's directly the federal government guaranteeing certain types of mortgages via Ginnie Mae that are extended to low-income borrowers or mortgages with small notional balances. Fannie Mae and Freddie Mac are agencies that are kind of quasi-government guaranteed. There's not an explicit guarantee, but it's sort of an implicit guarantee by the federal government. But the role of these agencies is to guarantee the credit risk of these mortgages. Right. And so what happens is in the US, the mortgage market is funded through capital markets. So most mortgages, the lender is effectively an investor. It could be an insurance company, it could be a pension fund, it could be a bank who effectively extended the money to allow borrowers to contract their mortgages. And so these investors in mortgage markets, they mostly absorb and are exposed to interest rate risk, the risk that interest rates go up and down, and the credit risk of the agency mortgage market is absorbed directly or indirectly by the federal government. So this is what we call the agency mortgage market, which is basically mortgages below the conforming mortgage limit. Above the conforming mortgage limit, we have the jumbo market. The jumbo market, there's no credit guarantee by the federal government. The jumbo market, the biggest lenders are the biggest banks in the United States. And these banks are very conservative in their underwriting criteria so that the credit risk is really a minimal in those mortgages. And once again, whoever takes the risk of a mortgage in the jumbo market is mostly exposed to fluctuations in interest rates.
So the first mortgage I received when I bought a house in the 60s, the local savings bank kept the mortgage for 30 years, ostensibly for 30 years. And that's the way it worked. Today, it's a wholly different market. How large is the US mortgage market?
Yeah, so nowadays, the fixed rate mortgage market, the outstanding balance is around $12 trillion, right? So it's approximately 50% of US GDP. In terms of face value of mortgages originated nowadays, 50% of these mortgages are effectively guaranteed by Fannie Mae, Freddie Mac. Another 25% is guaranteed by Ginnie Mae. So, overall, 75% of new production is really mortgages that have no credit risk because the federal government absorbed that credit risk. And then the remaining 25% are jumbo mortgages originated by large commercial banks to, borrowers who basically are, buying a large home and need, financing that's greater than the conforming mortgage limit.
In this $12 trillion market, there was a period in and around COVID when the government forced interest rates much lower and people refinanced their mortgages because mortgages were available at sometimes below 3%, but certainly at 3.5%, 4%. How much of the $12 trillion mortgage market was refinanced, do you think, during that period?
Right. So you're absolutely right. So during the COVID period in 2020 and 2021, you had extraordinary action by the Federal Reserve. In particular, the Federal Reserve brought short-term interest rates to zero. The Federal Reserve started to buy aggressively fixed income securities, in particular treasuries and US agency mortgage-backed securities. And so that brought down the term structure of interest rates, that brought down long-term interest rates, and in particular, that brought down mortgage rates. And so during that time period, 2020, 2021, when 30-year fixed mortgage rates reached levels of around 3%, even below 3%, as you say, I suspect around $3 to $4 trillion of mortgages were refinanced at such time. Now, this is just part of what happened during that time period. We can also move back to 2018, 2019, where mortgage interest rates were low. They're not at historical lows, but they're quite low. And same thing, if you look at the time series, in the, late 2010, so again, 2018, 2019, you have also a significant volume of refinancing happening as mortgage rates were coming down through that time period.
So let's use 3% just because it's easy. A 3% mortgage in today's mortgage market of roughly 6.5%.
Yes.
What would it be worth?
So today, if that mortgage was trading in a pool of mortgages in an agency mortgage-backed security in the secondary market, it would be worth probably below 70 cents on a dollar. So if we're talking about
there's a 30%. Go ahead.
Sorry to interrupt you, Larry. Yeah, we're talking about 30% discount to face value. So, whatever, if we're talking about $100,000 face value mortgage, that mortgage, the price that an investor would put on that mortgage with a below market interest rate would be $70,000.
So in a $4 trillion refinancing, roughly $4 trillion, at a 30% discount, there's well over $1 trillion of value that's been created that nobody can realize at the moment. Is that fair?
That's very fair, Larry. It's exactly the way you phrased it is exactly the way I think about it. There's market value gain that mortgage borrowers enjoy because they effectively holding a mortgage that has an interest rate that's below current market rates. And that so you can think about this from the point of view of a household's balance sheet. If I'm a household, I have assets on my balance sheet and I have liabilities on my balance sheet. the asset did what they did, but the value of my liabilities went down during the increase in interest rates of 2022. And in the aggregates, we're talking about a net worth gain coming from mortgage price declines of between $1 and $2 trillion in the United States. And that's value, that's paper gains. And exactly as you said, these paper gains are not really accessible, or they're not really monetizable.
So the mortgagee that refinanced the mortgage, let's say at 3%, has this paper gain, but can't realize it, can't convert it to dollars, because the new buyer of the house can't assume that mortgage because the banks won't allow it, and the mortgagee can't buy back the mortgage. Let's say a $300,000 mortgage that's worth $200,000, can't pay $200,000 and extinguish the mortgage. So that money, that value, can't be accrued by anybody.
That's correct. So it's effectively, if we think about it from the point of view of trading fixed income, it's as if I was shorting a long-term bond, and interest rates would go up, that long-term bond value would come down. If I was a trader shorting that long-term bond, I could close out my short position and make the money. In the context of mortgages, I cannot, exactly as you described. And so this value is kind of locked in and cannot be realized.
So you're a homeowner with a 3% mortgage in this market, 6.5% market. You want to sell your house. What's going through your mind?
Yeah, so what's going through your mind is very simple. You have a very low interest rate on your mortgage. You have children that are about to go to school, so you need to maybe move to a different school district, or you just got a new child, so you need to increase the size of your home. And you're thinking, well, if I have to move, in the United States, there's what we call the due on sale clause. So if I have to move, I have to sell my property. If I sell my property, I basically have to repay the face value of my mortgage. So homeowners who have a mortgage would have to give up this low coupon mortgage at the time they move and buy a new property. And when they buy this new property, they would presumably finance it with a then mortgage at a then current market interest rate, which would be 6.5%. So what comes to their mind is the fact that they're losing a debt contract that's very valuable from their point of view.
Do you and your colleagues believe that the purchase and sale of existing homes in the United States is now significantly reduced because of this mortgage problem that we have?
Certainly, it's so. This is research that various colleagues of mine have pursued in the past couple of years to try to understand the effect of this mortgage lock-in on house price and the housing market dynamics. And there is significant and convincing empirical evidence that the mortgage lock-in effect have altered significantly the dynamics in the mortgage market. It has reduced the number of homes supplied by people possibly moving, but that are not moving because of this lock-in effect. And it has also reduced the number of people demanding homes. So in some sense, it has shrunk both the supply and demand. And a lot of the research nowadays in that area of real estate and economics literature is trying to ask and answer the question, has this lock-in effect tended to push home prices higher or lower relative to a world where this lock-in effect was not present?
Okay, so we've gone through the preliminaries. Let's talk about the Danish system. Is the Danish system, aside from the obvious, is the Danish system much like ours in terms of how they secure mortgages, government guarantees? Is it a replica of ours?
So if you were to speak to a Danish person, the Danish person would say, no, Larry, you're wrong. It's the US system that's a replica of the Danish system.
Okay.
And the Danish would say it's a poor replica of the Danish system.
Okay.
That being said, you're absolutely right. There's a lot of similarities between the two systems. Number one, the 30-year fixed rate prepayable mortgage product is also prevalent in Denmark. It's not as dominant as it is in the US. In the US, the vast majority of mortgages are long-term fixed rate prepayable. In Denmark, it's only 50% of the stock of mortgages that's long-term fixed rate prepayable, but it's a large fraction of total mortgage debt. It's also a system that's capital markets funded. In other words, the lenders are institutional investors, right? We're talking again about pension funds, insurance companies, banks who basically buy mortgage-related securities to fund the entire kind of a mortgage system in Denmark, just the way in the US, mortgage-backed securities investors fund the US mortgage market. It's a system where credit risk plays a minimal role, just as in the US, where the credit risk is absorbed by the federal government through Fannie Mae and Freddie Mac and Ginnie Mae. In Denmark, this credit risk is minimal and it's absorbed by mortgage institutions who are basically charging a small fee to borrowers in exchange for taking on credit risk. And most of the risk that capital markets investors who buy mortgage securities take is interest rate risk. So in both systems, interest rate and prepayment risk is a dominant factor that investors think about when they buy mortgage securities. In both systems, borrowers have an option to prepay and refinance their existing mortgage at par, at no cost, if you will. And the important subtle difference, which has dramatic implications in Denmark, is the fact that borrowers in Denmark, not only do they have an option to prepay at par their mortgage, just like in the US, they also have the option to repurchase their mortgage at market price. So concretely speaking, what does that mean? It means that in Denmark, when a borrower has a very low interest rate mortgage and interest rates have risen, that mortgage is maybe trading in the secondary market at 70 cents on the dollar. A Danish borrower will have the option to instruct a broker to repurchase the debt from the secondary market at 70 cents on the dollar and cancel that debt. Right. So, of course, for borrowers to be able to do this, they need to have the liquidity to be able to repurchase that debt at 70 cents on the dollar. Frequently, borrowers do not have the cash in hand. And so what they do is they just refinance into a higher interest rate mortgage with a lower face value. So in numbers, they're replacing a $100 face value mortgage with a low coupon into a $70 face value mortgage with a higher coupon. And that way, using your words, Larry, they are monetizing the capital gain that was embedded in their low coupon mortgage contract.
So if I have a $400,000 mortgage using your 30% discount or selling at 70% at market value, I can extinguish that for $280,000, put $120,000 in my pocket, and borrow at 6.5%.
That's exactly right. So in the math, the math you're giving is exactly right. So presumably, if you were staying in your home, you would basically change your $400,000 mortgage with a 3% coupon. You would buy it back for $280,000, right? And then you would get a new mortgage for $280,000 at a higher interest rate, right? And so if you think about this from a point of view of your loan to value ratio, the loan to value ratio is the ratio of the mortgage face value divided by your house price. Well, your loan to value ratio has significantly improved, right? Your indebtedness has significantly shrunk. If I think about your indebtedness using face value. And so this, if I think about this from the point of view of the household's balance sheet and household's net worth, the net worth has increased significantly on paper when interest rate rose. And this net worth gain was crystallized and monetized when the household bought back its debt at market price.
I'm thinking of older people right now because of my age, but I would think that older people who are downsizing, either going into an apartment or buying a smaller home, could borrow much less or borrow not at all if they're renting, and take this asset, this hidden asset, and just add it to their balance sheet, add it to the bank account.
Oh, certainly. I mean, there's definitely an interesting kind of a age-related kind of aspect that we don't spend too much time working on in our own research. But the truth is, this option to repurchase at market value is really utilized broadly by borrowers in a fixed-rate mortgage market in Denmark, and this has dramatic consequences for refinancing behavior. What this means is that in Denmark, during this rise in interest rates, we observed a lot of refinancing. Whereas in the United States, during the same time periods, 2022, 2023, nobody refinanced, right? Because nobody wants to replace a low interest rate mortgage into a high interest rate mortgage. So refinancing behavior is dramatically altered by this repurchase at market option. But not only refinancing behavior is altered, but also moving behavior is altered. As I hinted at before, Larry, in the US, this dramatic rise in interest rates has significantly dampened mobility for US households that have a fixed rate mortgage contract. Whereas in Denmark, in the end, this increase in interest rates has barely had any effect on mobility for Danish mortgage borrowers.
So the Danes, you're saying, frequently use this mortgage system to their advantage.
Very much. If I look at the data, so the interest rate rise in the US and Denmark coincided. It started in 2022, and during the period 2022-2023 in Denmark, between 50 and 60% of households either repurchased and refinanced these discounted mortgages or moved and crystallized these mark-to-market gains that they effectively enjoyed on their balance sheet.
If the US wanted to use a similar system, is the Fannie Mae, Freddie Mac, Ginnie Mae an impediment to that use? Would it be an impediment to us adopting the system?
So there would need to be some institutional infrastructure changes. You could still use the current system where Fannie, Freddie, and Ginnie Mae are acting as credit guarantors for agency mortgages. You could implement the Danish system either through changing the guarantee rules. So remember, Fannie and Freddie, they guarantee the principal balance of mortgages. If you were allowing households to prepay at the lower of par or market value, you'd have to change the nature of the guarantees that Fannie and Freddie extend. That's possible. It doesn't even require an act of Congress. You would just need to have the folks at the FHA, the FHFA, which is the regulator for Fannie and Freddie, change the terms of the guarantee rules. So technically, it would be possible on a going forward basis to adjust the institutional infrastructure in the US to adopt this buyback system. The biggest hurdle, in my view, would be the fact that by introducing this buyback option in the United States, you will push up equilibrium mortgage interest rates. This option is not completely a free option. It would affect mortgage rates, and the question would be to what extent policymakers feel comfortable that the increase in interest rate induced by this option is worth it.
Well, every institution that holds these mortgages would have higher costs or lower profits in some way. How much do you think mortgage rates would have to be increased to offset that cost?
Yeah, so it's exactly right. So the way you phrase it is exactly right. Institutions who hold these mortgages, they would basically give up some optionality, and so they would have to charge more for this option. Our calculation suggests that this cost would be, on average, around 18 to 20 basis points per year. So it would increase mortgage interest rates on average by around 18 to 20 basis points per year. And the key reason for this increase, it's important to understand why mortgage interest rates would increase in the US if you were to introduce that option. Nowadays, in the United States, what happens is that if I'm an institutional investor and I have on my books a discount mortgage, so a mortgage that has a below market coupon, so from time to time, these mortgages prepay at par. Why do they prepay at par? Because there are some households who still decide to move. Even if they have a below market interest rate mortgage, they still want to move for all sorts of reasons. And so from the point of view of an investor, the investor has a mortgage trading at 70 cents on the dollar that suddenly pays 100 back because the household decided to move. So these are kind of gains that happen from time to time that investors enjoy today, but that they would no longer enjoy in a world where households were allowed to buy back their mortgage at a discount. And so, of course, this would rise equilibrium mortgage rates, and the degree to which equilibrium mortgage rates would rise by depends on how frequently these mortgages trade at a discount. And when these mortgages trade at a discount, how frequently is it that people move and prepay at par? And so what we find in our research is that that increase in interest rate is very dependent on the level of interest rates. When you live in a very high interest rate world, it's unlikely that in the future mortgages will trade at a discount, and so this option is really not worth much. Whereas if you live as as we were living in 2020 in a very low interest rate world, it's very likely that going forward, at some point these mortgages will trade at a discount. In which case, the option is becoming worth quite a bit.
And do the Danish purchasers have the option of either participating in this not free option, but option, or declining it?
No. It's in Denmark. You don't have a contract choice. All mortgage contracts are structured with this option embedded in it. It would be an interesting and very nice for researchers, at least. It would be a really nice research design to be able to observe both mortgage markets and mortgage prices, because if we were able to observe both mortgage prices, we would be able to directly observe the cost differential of this option.
Yeah, because 6.5%, as you point out, I don't think mortgage rates are going much higher, or they haven't historically gone much higher. So I don't need this option, and I'm better off not paying the 20 basis points.
That's right. I mean, the what I would say though is two things, right? I mean, I guess I'm not I wasn't an adult back then, but people keep reminding me of the 80s when presumably mortgage rates were in the
It was a moment in time. It was
exactly.
If you look back 100 years,
that's probably an outlier. That's probably an outlier. Yeah,
it's an outlier.
No, but what I would say, Larry, though, is going back to your point. When interest rates are high, like we think they're high today, the value of this option is not worth 20 bips. It's worth much less. And so, if we were to offer this product, the increased interest rates that the household would have to face would not be kind of significant. It would not be 20 basis. It would not be 20 basis points. It would only be a few basis points. And so, if we think about this in the context of affordability, home affordability, this is really an option that doesn't really hurt home affordability, because in states of the world where we were worried about affordability, which is in a state of the world where interest rates are high, well, this option is not worth much, right? So it's really in states of the world where we're not necessarily worried about home affordability, when rates are very low, that this option would effectively increase rates by 25 to 50 basis points. And so that's an interesting discussion for policymakers to think about. If their concern is home affordability, this option, in some sense, goes the right way. It's really costly when home affordability is not necessarily a concern.
So in the United States right now, we have a lock-in. There are relatively few homes being sold and bought, aside from the new housing market for a moment. Is there evidence that in the Danish market, they're immune to this?
Yes, very much. That's what my empirical research shows. So researchers, including the researchers in my team, we perform all sorts of regression analysis to understand how moving rates are affected by the differential between the interest rate on your own mortgage and the current mortgage market rate. And what our research shows is that in Denmark, when current mortgage rates are significantly above the interest rates on households' mortgages, moving rates are very insensitive to this differential, right? To what we call the refinancing incentive, or the rate gap, right? The gap between the current mortgage market interest rates and the coupon of a household's mortgage. In Denmark, the moving rates are very insensitive to this gap, whereas in the United States, there's a lot of empirical evidence that shows that the greater this gap between the current mortgage market rate and the household's mortgage coupon, the lower mobility. And to give you a sense of magnitude, effectively, when you look at mortgages that have an interest rate below current market rates, every 1% increase in the current mortgage market interest rate leads to a decline in mobility of around 80 basis points per year.
Every 1% increase in mortgage rates results in a declining mobility of 80 basis points?
Per year, yes. For those households where the mortgages is as a coupon below current market rates.
And in Denmark, they're insensitive to changing interest rates?
That slope is about zero.
How long has the Danish market had this feature in their mortgage market?
It's a great question. I suspect they had this feature for at least 30 to 40 years. So the Danish system has gone through different phases. It's a very old model that when I speak to my Danish colleagues, they would explain to me that this is a system that has been designed over the last 400 years. But presumably this feature has been really prevalent in the mortgage system for 3-4 decades minimum. Now, the truth is this feature, this buyback at market option, it's the first time really that we really observe it and we see it at work. Because if you remember the time series behavior of long-term interest rates, whether it's in the US or in the Euro area, we've really had a secular decline in long-term rates since the 80s, right? Since, we talked about, mortgage rates in the teens in the middle of the 80s. Whether you look at the Euro area or the United States, we had a secular decline in long-term rates up to 2021, at which point, the Fed in the United States, the ECB for the Eurozone significantly increased interest rates and made this buyback at market option relevant in Denmark.
Do the federal agencies concerned with housing agree that one of the primary reasons for the housing slowdown, purchase and sales, is the lack of supply in the market due to this lock-in effect?
I am not sure, Larry. I don't want to speak to on behalf of regulators and policymakers. I would say that it's one of possibly many kind of causes that has led to this slowdown in purchases and sales of housing in the U.S. I would say though that people have in terms of the lock-in effect, when it comes to thinking about ways to alleviate and reduce this friction in terms of mobility. Nobody has really thought too hard about this buyback option, right? It's the solutions that a lot of people have thought about and have put forward in the recent past to alleviate this lock-in effect have been about what we call assumability or portability. And I think you hinted at this in your introduction, the idea that assumable mortgages, if I own my home and I have a mortgage at the below market rates, the day I sell my home, I allow the new purchaser to step into my shoes and become the new borrower and enjoy this low coupon mortgage. So assumability is something that people have talked about. Portability is another feature that people have talked about. The idea that portability is the idea that I own a home and I have a cheap mortgage today. I decide to move, sell my house and buy a new property in a different location. I will port my mortgage to the new location. So these are contractual features that have been talked about. They exist in certain countries. They exist in certain mortgage markets. The empirical evidence suggests that these features are difficult for borrowers to efficiently utilize relative to the buyback option we see in Denmark.
If it was assumable, I would charge more for my house if I had a 3% mortgage.
So the assumability would allow you to capitalize the value of your mortgage into a higher home price. So in principle, it would be fine, right? If this was simple. The challenge with assumability is that the day you sell your house and you basically allow the purchaser to step into your shoes as a borrower, the challenge is that the lender has to give consent. So there's a consent from the lender that is required. So the lender is going to re-underwrite the risk of the new borrower. The other thing you need to think about is that at the time you sell your house, well, your house has possibly appreciated between the time you bought your house and the time you're selling it. So your house has appreciated, your mortgage has shrunk through amortization. And so the new purchaser, may want to be able to step into your shoes to effectively borrow via your mortgage. But that mortgage for the new purchaser might be too small. So the new purchaser might need to complement this first mortgage with a second lead mortgage. So this introduces a lot of frictions and complexities in coordination and bargaining and lender consent that make mortgage assumption very difficult to use. And the reason why I say this is that there's data supporting my argument. In the United States, there's a segment of the mortgage market where mortgage assumptions is allowed. So if you look at FHA mortgages and VA mortgages, it's possible for borrowers to effectively sell their property and have the new purchaser assume. In the data, there's approximately $2,000 to $3,000 mortgage assumptions every year, which is a minuscule fraction of the
Yeah,
stock
it's small.
of FXA mortgages. In Denmark, mortgages are both repurchasable at market prices, and they're also assumable. And households never use the assumption feature. They always use the buyback feature.
You mentioned friction before. I have a friend who took advantage of the mortgage market by refinancing her apartment twice. And both times she was charged all kinds of mortgage refinancing fees by the bank because they were assuming they had to do all kinds of studies to determine whether she was creditworthy. I mean, she had paid her mortgage interest and principal every month for years. But what's that all about?
Yeah, so I wholly agree with this idea. This is not my research, but there's definitely kind of research that focuses on refinancing and frictions in the market for mortgage refinancing. In the US, the challenge is that at the time of a refinancing, the lender is re-underwriting the credit risk of the mortgage borrower. It's a requirement by the agencies. So if it's an agency mortgage, the agencies require the refinancing to be re-underwritten. So there's all sorts of documentation that needs to be collected. So loan officers have to spend a lot of time and effort to effectively do that due diligence, collect the documentation, etc. And so this has costs, which in some sense, it's unclear why we need these mortgages to be re-underwritten, right? At the end of the day, the credit risk of these mortgages is in the hands of the federal government today. By refinancing into an agency mortgage, the credit risk stays with the federal government. So there's really no reason to re-underwrite the mortgage. And in fact, that line of thinking has been acknowledged in Denmark. And so in Denmark, if you have a mortgage with a particular mortgage institution and you want to refinance with that same mortgage institution, there is no re-underwriting. So it's very streamlined. And because it's streamlined, the refinancing costs are empirically much lower than they are in the United States.
Absurd. Does this phenomenon that we're talking about have any effect on the number of new homes that are being built? Because we know that this is a significant decline in the number of new homes. Does this phenomenon affect those new homes being built?
So that's a good question. So I would say the lock-in effect does not necessarily, I don't think it has a direct effect on new home construction. However, the level of interest rates that we have today, right? We have, as you said, 6.5% mortgage rates definitely has an effect on home construction, right? The fact that builders need financing to finance the construction of new homes, and if their financing costs are much higher than what they were, 5 years ago, it's going to be more costly for these home builders to actually build new homes. So I'd say, once again, this is not like a directly research that I've conducted, but I suspect there is evidence that builders are affected by the overall level of interest rates.
What are the worst impediments to the U.S. adopting such a system?
I might be biased because this is my own research, but I would say there's really no downside in adopting the system outside maybe the fact that rates would increase on average by 20 basis points. With again this idea that this increase is not uniform, it's going to be state dependent. Possibly the second effect that we might be worried about is that this option might be utilized more frequently by financially sophisticated people, savvy people, and less frequently by households who have low degree of financial literacy. So this may exacerbate inequality. This may exacerbate the idea that people who are financially literate and financially sophisticated tend to use the option embedded in financial markets more efficiently than low financial literacy people. So to the extent we had this buyback option, maybe this contributes to exacerbating inequality. But again, again, with my biased opinion from, having pursued this research for many years, I really think this is a no-brainer relative to the alternatives, which are assumability and portability.
Can I assume that the Fed has studied the Danish system, has looked at it over these 40, 50 years that it's been in existence,
So
and has not reacted to it?
I don't think the Fed would be the right kind of a regulator slash, policy or institution to actually look at this. I think probably the better institution to look at it would be the FHFA, right? The regulator for the housing for the agencies.
I accept the correction.
The FHFA, I think, has focused on all sorts of issues of the recent past. I suspect, they may have people, at the agency kind of looking at this particular feature of the Danish system, but they are really working on all sorts of things. They have been, discussing, as you may have heard, they've been discussing kind of longer term mortgages. So as opposed to looking at 30-year mortgages, we look at 50-year fixed rate mortgages, really thinking about home affordability. They have been thinking about to what extent we can decrease mortgage rates by having the Fed buy more mortgage-backed securities, right? To what extent we can put pressure on long-term rates by having the Fed buy mortgage-backed securities. So there's, I think, all sorts of discussions. From what I can see from the research production from the FHFA, I don't think there is like a very high-level research effort focusing on this. Once again, I need to say, introducing this feature would not solve the problem with the existing stock of mortgages.
Let's be clear on that one.
We cannot change that. And on a going forward basis, it'd be better. But again, the issue is really, policymakers, to what extent they have an incentive to fix problems that future generations will face. Unfortunately, the incentives for policymakers is to really think about existing problems and not to fix, future problems.
What's the average length of a mortgage actually, not the 30-year mortgage, but a 30-year mortgage lasts for how long on average?
Yeah, it's much shorter than 30 years, as you said. I mean, effectively, it depends on the interest rate cycle. It depends on where you are in the interest rate cycle. So when mortgage rates were on their secular decline, in the 2000 and 2010s, on average, the mortgages were being prepaid, around 20% per year, 30% per year when you had the dips in mortgage rates. So we're talking about effective durations of 4, 5, 6, 7 years. Now that, now you look at 2020, 2021, when rates were at historical lows, well, we're probably going to have effective lives of these mortgages that are much longer because now people are in love with their 2.5% mortgage product, and they're just not going to get rid of it and give up that contract that easily.
I have one last question before I know Gwen is going to want to ask some questions from the audience. What is the lock-in effect doing to labor mobility? Are people turning down jobs or promotions that would require them relocating because they don't want to give up their mortgages?
Yeah, it's a great question. It's a question that's been the focus of some empirical work in the US. The biggest focus in the US has been on what are the moves that are being prevented by this lock-in effect. Are these moves exactly as those you're describing, which is job related? So I live in New York and I get a great job offer in California. Do I not take it because I have a great mortgage and I want to keep it? The empirical research that I'm aware of suggests that these job-related moves are not necessarily impacted significantly by the lock-in effect. Instead, the moves that are being affected the most are moves within zip code, within MSA, where effectively the mobility is related to households expanding or households shrinking, or kids going to school and households trying to move into a better school district. So these within zip code moves have instead been much more impacted than the moves related to job opportunities. So if we think about the welfare costs of the lock-in effect, I mean, they could be coming from multiple different sources. It could be coming from the mismatch between jobs and workers. So the empirical evidence suggests that that's not too costly from a welfare standpoint because these moves are not being prevented. but the welfare is costs are really coming from people living in the wrong homes. So effectively older folks who are trying to downsize and maybe postpone their downsizing decisions because of this lock-in effect, or younger families trying to expand and preventing this expansion because they don't want to give up on this low coupon mortgage that they have.
I got it. Professor Webb has some questions from our audience for you, Fabrice.
Yes, we do have some
Great.
questions. Are you ready, Fabrice?
Absolutely.
All right. You estimate that this additional flexibility might raise mortgage rates by about 20 basis points on average. Do you think most borrowers would consider that a reasonable price to pay for the added protection and optionality they would have?
That's a huge question. The only way we could empirically answer that question would be maybe through survey, or it could be in a world where both options were available. So imagine in a future world in the United States, lenders would offer both a mortgage with a buyback option and a mortgage without. To what extent borrowers would understand that they may be paying a little bit higher for their mortgage, but that higher cost might lead to more flexibility down the road. Unfortunately, there's some evidence in the U.S. that people tend to be short-sighted and tend to favor kind of lower cost options, even if these lower cost options lead later on to more frictions. But I think to be able to legitimately answer that question, I think surveys would be one way to go about it. Or in the ideal world, if we had lenders offering these two contracts, we'd observe how much one contract is being taken versus the other.
It would also depend on interest rates. At an interest rate level of 6.5%, the option's worth something. At 3%, perhaps not.
Absolutely, 100% agreed, Larry. Yeah.
All right, here's another question. Could a Danish-style mortgage system have helped reduce the severe housing market lock-in that we've seen since the interest rates rose after the pandemic?
Yes, no, it's exactly kind of the focus of my research. So in a counterfactual world where the U.S. had this buyback option, when we went through 2021, 2022. My research suggests that the housing market would see many more transactions, many more sellers putting their home on the market and moving, and to the same token, many more buyers effectively purchasing property. So my research definitely suggests that this buyback option would have had significant effect on housing transactions.
Do you think that the markets would have been, do you think that this is a more important option when markets are tight, or when markets are have good balance of buyers and sellers?
Fantastic question. So this is not my research, but I have colleagues and friends in the academic world who have actually looked precisely at this question. And the reasoning that these researchers go through is as follows. In very tight markets where basically the number of buyers dominates the number of sellers, the lock-in effect will tend to make the markets even tighter and will tend to basically push up house prices, right? And the idea is, if I can use numbers, in a tight market, let's say you have a tight market where for every seller, you have 2 buyers, right? So imagine you have a market where you have 100 possible buyers and only 50 possible sellers. Well, the lock-in effect will subtract the identical number of buyers as it will subtract the number of sellers. So if the lock-in effect subtracts 20 buyers and 20 sellers, the seller to buyer ratio will go from 50 to 100 to 30 to 80. So we're going to get into a tighter housing market, presumably pushing up home prices. So the research that I'm aware of suggests that this lock-in effect has the most effect on house prices in zip codes where markets were tight to begin with.
Wow. Fabrice, what is the biggest practical obstacle to introducing the type of mortgage option in the U.S.? Is it more regulatory? Is it more accounting rules? Is it the structure of mortgage-backed securities? resistance? What do you think would be the biggest barrier?
It's an important question that we talk about in our research. I think about it with the two different mortgage markets we have in the U.S. So let me try to talk a little bit about the jumbo market, where commercial banks dominate as lenders. And a lot of these, not all of them, but a lot of these commercial banks, when they originate a jumbo mortgage, they keep the mortgage on their books. So I'll give you an example. I buy a house and I take on a mortgage from JP Morgan Chase. It's a jumbo mortgage, and I have, I negotiated a very low interest rate, 3%, and then mortgage rates increase. And the mortgage is still with JP Morgan Chase. Conceptually, from an economic value standpoint, this mortgage for Chase is worth much less than par. In theory, it could be worth, let's say, 70 cents on a dollar if I have a mortgage at 3% and current market rates are 6.5. So I should be able to go back to Chase and say, hey, Chase, this mortgage that you have on your balance sheet, it's now worth 70 cents if it was trading in the secondary market. Why don't you agree to cancel it? And why don't you agree to cancel it and I'll pay you 72? If I pay you 72, it's a gain for you from an economic standpoint, because it's worth 70. I pay you 72, you should be happy. And I'm happy because I monetized my net worth gain coming from this interest rate rise. Unfortunately, accounting and regulatory capital rules for banks prevent or deter banks from doing this, right? A lot of these mortgages are portfolio loans that are held on banks' balance sheet at cost. So irrespective of the behavior of interest rates. So interest rates could have risen dramatically. Banks, from an accounting standpoint, are still recognizing the mortgage at cost. And so they will be highly reluctant to entertain a discount repurchases, because the discount repurchase would immediately trigger an accounting loss. And they don't like this. And not only they would trigger an accounting loss, but it also would trigger a hit to regulatory capital ratios. Because again, regulatory capital rules are tightly linked to accounting rules. And so the commercial bank entertaining the buyback option would effectively recognize an accounting loss and also a deterioration in its capital ratio. They don't like it. So, to try to reduce this friction for the jumbo market, you would have to have a reform of accounting and regulatory capital rules. Accounting rules would have to change so that accounting values are much closer to economic values for banks. So that's number one. Number two, for the agency mortgage market, you would have to figure out an infrastructure that would allow borrowers to buy back their mortgages. And one way to do this would be to effectively have a repository. So every borrower, would have a mortgage with a particular number. And every borrower would know exactly where the mortgage is located in the mortgage-backed securities market. So you know exactly which MBS holds your mortgage. And the day you want to buy it back because it's trading at a discount, you could instruct a broker to go out and buy back in the secondary market a particular piece of the MBS that warehoused your mortgage, at 70 cents on a dollar. And then once, that piece has been acquired corresponding to the face value of your loan, effectively, you would have a mechanism to cancel that loan. And so that would effectively, allow you to replicate the Danish system. So conceptually, there is some infrastructure and some plumbing that would need to change. But from my perspective, it's not a dramatic reform to the mortgage system. It's only an incremental reform that would, on a going forward basis, kind of alleviate this lock-in through the buyback option. Now, again, it's work from a regulatory standpoint that would need to happen, that the FHFA would need to actually think hard about. And I'm not sure this is at the top of their list of priorities nowadays.
Wow, that's a lot. Do you think it's very likely that any of these changes will actually take place in our lifetimes?
Look, so let me say it this way. The number one thing that the FHFA has been talking about for the last 15 years is the privatization of Fannie Mae and Freddie Mac. And if you look at the four different the administrations that have successively taken over, Fannie and Freddie, we're talking about the Obama administration until 2016, the Trump administration until 2020, the Biden administration. All these administrations, one of the things they said to the FHFA is figure out a way to privatize. It's been 15 years we've talked about this. It's still not happened. So I'm a bit skeptical. If we were in a different political environment, maybe. So that's kind of the short way to answer your question, Gwen.
If I can just add something, Gwen, I'm amazed that some governmental agency hasn't contacted you and your colleagues as a result of this paper.
We've tried to reach out to them. In fact, I think we have been able to speak to a few people, and so I think it's a matter of time, Larry. I think over the more we present, the more we. So it's only a paper that we've been presenting for the last few months. So again, things take time. So I'm hopeful that in the next year or two there'll be more visibility, and we'll be able to have concrete discussions with policy folks and particular folks at the FHFA. But again, as I mentioned, I think if I think about their agenda, I suspect that they're much more focused on these kind of super important questions around like privatization of Fannie and Freddie, and this may be a second order thing that is not necessarily on the front line of their priorities.
It only affects millions of Americans.
We are at the end of the hour. It's really been a compelling discussion. It's really interesting to hear about this. It's something that I think many of us were unfamiliar with this option in the Danish system, and the fact that we're so accustomed to this lock-in effect. But it is the end of the hour, and Larry, I'd like to ask if you have any last words on this topic.
Yeah, my last words are, I'm so glad that Fabrice is teaching at Baruch.
I think so am I. I think so.
So are
all of us. I think that we will let you know what our September webinar topic will be very soon. And until then, thank you, Fabrice. Thank you, Larry. Thank you, Bruce.
Thank you very much for the opportunity.